What if you'd never had to raise money for a deal? What if you could buy deals even though you didn't have any cash? What if you didn't have to split up the deal and be like all the other syndicators who have a million general partners and they're giving away 80, 90% of the equity to the investors and they're walking away with 2% of a deal? What if you could control the majority of the deal or even all of the equity in the deal? What if you didn't have to deal with monthly reporting to your investors? What if you didn't have to file PPMs and register with the SEC and do syndications? What if these deals were easy to find? What if those deals that work in this model were actually everywhere? What if you could pay pretty much any price for any deal and make it work under this model? Guys, I'm really excited about something I'm working on in the deal room. It's something that I have personally done 6 or 7 times. And I've talked about this on my podcast, but I'll admit it's confusing. It's very detail oriented. There's a lot of ins and outs on how to do this, how to get the seller on board with it, the bank on board with it, the financing, how to structure it, and how to know if you're making something a good deal and you're going to be able to get out of it and sell it at a profit or refinance it and cash flow it, or if you're just over leveraging so that you can just get yourself into a deal and it's going to be a problem. And I've been trying to teach the people in the deal room how to do it. I've even taught some of this stuff on the podcast. I think 2 episodes ago, I went into a big seller carryback deal that we're working on. And what I've found and the feedback I've gotten is it's kind of confusing and it's really hard for people to follow this. But why I'm passionate about it is because it is so powerful. So I'm going to get into that, what I'm working on in this episode. So hang around with me. But before I do that, I just wanted to give you guys a couple updates on my life, what's going on. So number 1, debt fund is going really well. We got $500,000 worth of commitments to the debt fund last week. Those hopefully will be filtering in this week and next week. We're getting close to breaking our goal of $2 million. I'm really excited about that. Secondly, the flex space. If you've been following me on the flex warehouse space, I did a webinar. If you've missed the webinar and you want a copy of that webinar where I break down how we're doing it in case studies, how much it costs, how much I paid for my land, how much my materials are, what I'm going to sell it for, how I raise the money, all that stuff. If you want that, shoot me a message. DM me on Facebook, Instagram, whatever. I'll shoot you that webinar, no charge. And in that webinar, it has the deck with all the tools that I use, my actual budget, how I underwrote the deal, the pitch deck that I use to raise the capital, all that stuff. I'll give it to you. Just shoot me a DM or message on Facebook or Instagram if you want that. And then lastly, pickleball. Okay, so guys, you heard, if you've been following me, you know I went down to Florida and played in the U.S. Open pickleball. And this was a national tournament. I played in the men's 4-5 to 5-0 division, and I got my butt handed to me. It was, at the time, I thought a pretty terrible experience just because we lost every game. We got quickly eliminated, and it was difficult because I had prepared a lot for that tournament, and my nerves got the best of me, and the pressure got the best of me. I didn't play well. I feel like I kind of let my partner down. And then on top of that, when I came back to Charleston, I played in another tournament maybe a few weeks later. Also did not perform very well in that tournament either. And so I haven't done a tournament now for maybe 5 months, 6 months, and just been drilling, practicing, playing, and a little nervous. But this tournament came up and it was at my home court, the country club I'm a member of. They have pickleball courts and they're putting on a tournament. And it was a big tournament. There's 80 people in this tournament. And I decided to enter 2 events, mixed doubles and then men's doubles. And the men's doubles, I did the men's 4-5 division. So pretty tough competition. And I went out there, and something that I really noticed was that overwhelming, crushing pressure, that nerves, that heartbeat, that losing my breath because I'm so nervous. It wasn't there. And the level of this tournament compared to the one down in Florida was way less. And so I had like really, really stretched and reached way outside of my comfort zone going down to Florida. And even though I lost every game down there and didn't perform to my best ability and let the nerves get the best of me, the only way to get better at that is to do it. And I got to see a little bit of progress, a little bit of results in this tournament I played last weekend, last Sunday. And I was fluid. I was confident. I was calm. I was playing really well. I played to the best of my abilities, actually played a little better than I usually play, and ended up winning most of my matches. I did lose in the gold medal match, but I took home the silver. So really psyched about that I did well. And I was just reflecting on, man, if I hadn't have done that tournament that had put me way out of my comfort zone, I don't know that I would have performed so well in this tournament. And now, after doing this tournament, I have more confidence and less nerves going into the next one and the next one and continuing. And it just kind of translates to this stuff, right? I'm getting out of my comfort zone with the flex, and that was really, really scary at first. But then the more that I researched it and the more I dug into it and the more I figured out about it, I got more comfortable around it. And anytime you're doing something that's new or bigger or scary, like, it's going to be hard and it's going to be scary and it's not going to be fun. And if you're too comfortable, you're probably not growing. You're probably not doing what you should be doing. And guys, I have been the most alive and happy and driven that I've been in a long time working on this project, this big development project. So I just wanted to give you that update and throw that out there. So let's get back to the task at hand for today. A new opportunity is on the horizon, and it's because of the way that the economy and the cycles are going. Okay, so we are faced with a very unique situation. Prices went sky high in COVID. That's not news to anybody. It went really, really high. Rates went really, really low, and people overpaid. And the people that didn't overpay, that had already owned prior, they got their barometer moved up as to what they thought their prices were, right? So if you owned a 40-unit apartment complex and your neighbor sold his for $100,000 or $150,000 a unit, you subconsciously think, oh, well, now my property's worth $150,000 a unit because he sold it for $150,000 a unit. And even though I only paid maybe $50,000 a unit 10 years ago, I now believe that my property's worth $150,000 a unit. And so this huge price increases over, 2 or 3 year period, kind of cemented in sellers' minds, this is what your property is worth. Then rates went way up and values declined. What people could afford to borrow to make these deals work was less and less and less the more that the rates climbed. And yet sellers, for the most part, kind of stuck to their guns. They're like, well, I want $4 million for my property. And even though the underwriting says it's only worth 3.2, I want $4 million because that guy sold his for $4 million a year ago and my property is just as good as his and I want $4 million. And so we're kind of in this gridlocked market to some degree. Now, there are distressed sellers who have maturing debt or other, external factors that are forcing sales. And we are seeing a trickling effect of some pricing coming down. But we're not in a hot market. And the guy that wants a little too much for his property, he isn't transacting. And there's not lining up with buyers who are getting cheap debt to buy his property, but he still wants to transact. How can we capitalize on this phenomenon that is right here in front of us, that has evolved over the last 3 or 4 years and is probably here to stay for the next 2 to 3 years? So what can we do? We can't control the markets, but we can look at what's going on and we can shift and adapt and adjust and we can capitalize on that. And that's what I want to talk to you guys about today, is how you can capitalize on this weird dynamic that we're seeing in the market. Okay? Because the problem with the guy that wants $4 million and it really only pencils out at 3.2 or 3.5 is that you got to go out and raise $1 million in cash from investors. You've got to promise them a 15 to 18% return. You've got to give away 60, 70, 80, 90% of the equity of your deal to get that $1 million in to buy that deal. And then, you still got to service your debt, which is expensive. And you have this cost of capital from your investors that you've got to make a return for them. And so deals just don't get done because investors are gun shy. They're not really wanting to invest in multifamily unless it's just a bomb ass deal. And you got to give away most of the deal. You got to take on all the risk and get the loan, and you're overpaying and the cash flow is tight. And so why are you going to do that? And you're not. You also have to give up, I just said that you got to give up most of that. But these deals, they're legitimately everywhere, and any deal can work at any price given this model. Okay, so the model I'm talking about, if you haven't figured this out yet, let's just say you get a deal, and it's a good deal, it's in a good market, it underwrites, it pencils in at $3.2 million, $3 million, or let's say $3.2 million, it pencils at. But the seller wants 4. Well, if you can go to that seller and say, hey, I can get you 3.2 straight up, no frills, no questions asked, we'll just close it. But I know you don't want that. I can't quite get you 4, but what if I could get you 3.8? Would you be open to carrying some paper on that deal? Would you be open to like a seller financing option, but you're still going to get the majority of your cash at closing? Would that be something you'd entertain? And 9 times out of 10, they're going to say, well, yeah, maybe, depending on the terms and depending on your credit worthiness and depending on a whole bunch of stuff, but maybe, whereas 3 years ago, they would have been like, dude, kick rocks. I've got 4 all cash offers. I've got, 3 people that are using bike financing. I've got over ask. Like, I'm not messing with you. I don't want to carry any paper. I want all my money now. Who doesn't want all their money now? But their offers aren't coming now. And they still want that price, and it's stuck in their head. And they're like, well, I can't get 4, but I can get 3.8. That's pretty good. So what does that look like? Okay, well, we could get you $3 million in cash at closing. You can pay off your loan, maybe put some bucks in your pocket, and you carry an $800,000 note, the balance, for X amount of years at X interest rate, and we can make this deal work. And if they say yes to that, you've eliminated a whole host of problems, right? You've eliminated the need for investors. You've eliminated the need to split up the deal. You've eliminated the need to report to anybody other than the bank and the seller. You got to pay them. You've eliminated the need for a PPM and a syndication, and you own that. And if you structure it right, you can make that deal cash flow. How? How can you make that deal cash flow? Well, it doesn't work. When I say it works for any deal in every situation, it can, but you got to get way out on the spectrum of creativity. Like, you got to get the seller to carry a majority of the loan, more and more paper at lower and lower rates, or 0% rate, or principal only, and they've got to stretch it out for 10 years, 20 years, 30 years, 40 years. That's where it can work when you're really, really overpaying for a property. But if you're penciling out a deal, and let's say you're close, like you're within 20 to 30% of what that seller thinks he should get for it. So, like, for example, they've listed this property at $4 million and it looks like, 3.2. You're within 20% of his full ask price. But still, that's pretty far off. That's $800,000 off. And so this is where this kind of scenario can work. And so in that, you got to solve. Well, first, I want to talk about like how to find these kind of deals and who it won't work for. So I'm going to pull up my little list, but essentially, because you don't want to throw this offer at somebody that it doesn't work for. So if the seller doesn't have any equity in the deal, this is probably not going to work. Like if they have a high loan, like let's say he's asking $4 million and he owes 3.6 or 3.5 or 3.8, obviously it's not going to work because he needs that much cash just to pay off his loan. So if they don't have any equity in the deal, then it's not going to work. So you need to look for deals that have been owned for a long time by somebody, right? They've owned it for 5 years, 10 years, 15 years, 20 years. They probably have a lot of equity and very low loan balance. If the deal is brand new to market, right? Like they just listed it a week ago, they're probably not too interested in this creative offer. They're waiting to see if someone will come in all cash or, they can get a clean transaction. Why wouldn't they? But if something's been sitting on the market for 6 months, 12 months, 18 months, they may want to hear what you have to say. If the seller wants or needs cash versus cash flow, or they need cash now for whatever reason, it's not going to work for them. If there is no value add potential, like there's no way to increase the value of the property, like it's already like maxed out, then it's probably not going to work. If this is like a syndicator who just bought this 2 to 3 years ago and they're leveraged up to their nose in debt and they've got the rest in investor cash that they need to give back, it's not going to work. So you got to find deals that this will work for. So the deal that I did, I mean, I've done this 6 or 7 times, but on the market for a while, older seller with low debt or no debt. They've owned it a long time. They've got a good solid property in a very solid location, and they have durable existing cash flow that you can count on and you can improve on it. So when I say durable existing cash flow, the deal that I did up in Indiana, the guy was collecting like clockwork $19,000 to $20,000 a month. So I know when I buy it, I'm going to be able to collect $19,000, $20,000 a month. And I know what his expenses are, and I know exactly what his NOI is, and I vetted that out. I also know that I can improve on it. I know he's way under market rents, and I can bring that rent roll from $20,000 a month to $30,000 to $32,000 to $33,000. We ended up bringing it to $33,000 a month within 3 or 4 years. So I know there's a room for improvement on this property. So it checked all those boxes. So when you find somebody that this will work for and this is going to be attractive to, that's when this deal works. When you try to, bark up the wrong tree, you're just going to get a no. So if you see something that's brand new listed that they just bought a year ago, like it's probably no equity in there. There's probably no way they can even do a creative deal. So don't go down that road. But if you find an older seller that's owned a property for a long time, it's in a good location, a good market, and they just want like a little too much for it, that's where this can work. Okay? And they're everywhere. I mean, that is not a hard criteria to find. So what you got to do once you find that avatar is you got to solve 3 problems, and then you got to figure out the 3 components of your offer. So here's the 3 problems that you have to solve. 1, can I service all of the debt with the existing in-place cash flow or NOI and still make a little bit of cash flow on top? Can I do that? How can I structure the deal to do that? Where I can service the bank debt, I can service the seller second note, the seller carryback, and there's a little bit of cash flow left over, and that's on the existing. That's on what I know I can collect month 1, month 2, right as I walk into that deal. The second problem you got to solve is, can I raise the value of this property enough to be able to refinance out that seller? So in our example, we're going to take on a $3 million bank loan and an $800,000 seller note. Can I get that valuation up to 5, 5.5, $6 million so that I can go to a bank and they're going to loan me 3.8 to take out my first mortgage and to take out that $800,000 seller note? Can I do that? And how long is that going to take me? And then third, is it worth it? You don't want to get so aggressive on these offers that you're doing work, you're taking on risk and managing a property for 10 years to make $100,000. Like that's not worth it. That's not worth the effort. So knowing what your limits are and backing into that and making a decision of, okay, I can make $500,000 in 5 years. I can make $1 million in 10 years over this deal. Yeah, it's worth it. I want to do it. Or, man, this thing is so tight. They want so much, and they're so obstinate on their terms. Like, I'm going to make $100,000, but it's like not worth the effort. So you got to solve those 3 problems, and then you got to figure out the 3 components of the offer. So, bank loan. First and foremost, like, what is that going to be? What are those rates going to be? How much LTV are they going to give me? And where are they going to constrain my loan on the debt service coverage ratio? Right? A debt service coverage ratio means if your net operating income is $100,000, they're going to want to divide that by 1.25. And that's, maybe $75,000. I know that math maybe isn't right, but your loan payment has to be less than your net operating income by a factor of 1.25. This is where it starts to get complex. Hopefully you understand what I'm talking about. Then you got to figure out the components of the seller loan. How much cash do you need the seller to loan you back to cover your closing costs, to cover your down payment, so that you can really walk into the deal for free with no money down? Maybe even get a check back at closing. How much money do you need? How much money's left over from your NOI after you've paid your first debt? And is there still some cash flow left over to make it safe and to build up cash reserves? And so you can figure out what is my monthly payment to them, and then back into the terms of, okay, I can pay this rate, or I can only do principal only, and how much time. That is the last thing, like the timeline of the deal. Like, does it not work within 2 to 3 years? Does it work in 5 years? Is it going to take 10 years for it to pay off? and stretching that timeline out and getting the seller on board with that. So solving the three problems: can I service all of the debt? Can I raise enough value in the property to refinance out the seller? And is it worth my time and effort? And then figuring out the three components of your offer. Like, how much bank debt am I going to be able to get on this? Okay, how much seller carry do I need to ask for? And then what terms and timeline and rates do I need to get from the seller to make this deal work? So if this sounds complicated to you, it kind of is, but at the same time, it isn't. The theory is pretty simple, but then the mechanics of it are in depth. There's a lot to go into. How do you approach this subject with a broker? How do you talk to the seller and instill confidence? If you can't get that bank loan, well, who's going to be your partner to help you get that bank loan so you can do this? Who's going to instill confidence in the seller that you can pay this loan back? Well, it might have to be a partner. How do I know what my bank debt's going to be? How do I know what terms? Like, there's a whole swath, a sliding scale of like how much you can pay and how good the deal is. And there's a ton of different options that could work. So I, kind of after doing this for years and years and years, it's like I can know in my head and feel around like what it's going to be. And I'll run a few scenarios manually and I'll figure out what I want to do. But that doesn't work for the average person. It doesn't work for someone that's trying to first get into this. In fact, I didn't stumble onto this strategy until I was a couple years into this. And I had to learn all this stuff kind of through trial and error. And so what I'm doing is I am completely updating our course. So we have a course, How to Buy Multifamily. It's part of the Deal Room. And there's a module in there that talks about this, but it really doesn't go in a ton of detail. It just kind of talks about it. What I'm going to do is I'm rebuilding that video module step by step by step by step, breaking that down into like 10 different modules of exactly how to do this, all the tools, all the paperwork, all the operating agreements. You may be thinking, well, a bank's never going to let me put a second on it. How do I do it with just a promissory note? How do I do it with preferred equity in the operating agreement? How do I find banks that will allow me to do a second on it? What criteria do they have? All those sort of questions are going to be answered in all these modules. The psychological talk with the seller, like if you're offering him a really low interest rate, he may not like that. So how do you get around that? How do you show him that by paying an extra high price, higher than maybe what the market's going to pay, he's actually getting a really good interest rate on his money? And then if you're getting a low interest rate, what is the actual time value of money price that you're going to be paying for this deal today? And showing you all the different scenarios. And how we're going to do that is we're going to build out a full analyzer. We have a very, very robust deal analyzer for multifamily. We're going to add on a tab. It's going to pull the data from when you've just underwrite a deal and you get close and you think it's dead because the seller won't come down by 20, 25%. Well, here's another option for you. Here's a way to make this deal work and to be able to keep all the equity yourself and not have to raise any money or put any money down. Wouldn't that be nice? We're going to have this completely built out in our analyzer so that when you click over on that tab, all it's going to ask you is, okay, well, what's the purchase price? And it'll give you all these scenarios of like, this is what you can do for bank debt. This is what you can do for seller carryback. Here's your different options. Here's 20 different options that would work. Here's the cash flows on each option. Here's the profitability on each option. It is going to streamline this whole process. And these video modules, when you go through them, you will have a deep, deep, deep understanding of how to do this. I can't explain all this stuff in 20, 30 minutes on a podcast, but if this is something that is resonating with you, you need to be in the deal room. What we are doing here is going to be groundbreaking. We are going to see an explosion of deals happening out of the deal room because I know this model works, and we've already helped I think 3, maybe 4 deal room members close deals under this exact structure, but it's been a lot of work for me, like walking them through the processes because I don't have all this stuff that's in my head documented in video format with transcripts, with all the documents that they need and an analyzer to show them how to do it. So all this is coming down the pipeline. If you want to be a part of it, I've already published the first rough draft to the deal room. they're reviewing it and giving me feedback on it. If you want to be a part of the deal room and you want to close deals this year and next year with no money down, no investors, not splitting up the equity, and you want to be able to find loan sponsors that can help you close deals like this, hit me up, shoot me a DM, shoot me a message. We can interview you, talk to you about what you got going on, see if you would be a good fit for the deal room and if the deal room would be a good fit for you. All right, guys, that's what I got for you this week. Make sure you spend some time to unlock your life. Peace.